Welcome to VitalCash. In this video, we dive into Warren Buffett's words on investment basics for beginners. 3 fundamental guidelines. Warren Buffett is one of the world's greatest investors, and he shares here the key principles he has followed throughout his remarkable investment career. His words offer valuable advice on how to approach investing intelligently and strategically. I started my investment journey at the age of 11, although I didn't truly immerse myself until I was around 7 or 8 years old. Unfortunately, I didn't dive in until I was 11. My first foray into investing was when I bought my first stock at the age of 11. I began experimenting with various aspects of investing, such as stock timing, chart analysis, and other intricate strategies. It was an exciting but profitless experience, and I continued this experimentation until I turned 19. During this period, I devoured all the books on investing available in the public library. I found the subject fascinating. Even though I lacked a proper framework for understanding it, I was searching for answers, hoping that deciphering the patterns on stock charts would provide insights into a company's future performance. Looking back, it seems a bit crazy, but I followed the crowd in those days, trying to make sense of the charts. Sometimes, I even turned the charts upside down, hoping for clarity, but it rarely helped. Then, in 1949, I stumbled upon a book that changed my perspective on investing. The Intelligent Investor by Ben Graham. Up until that point, I had never heard of him, but 2 chapters in the book became the bedrock of my investment philosophy. These chapters laid out 3 fundamental principles that are deceptively simple yet incredibly powerful. The first principle is that a stock represents a share in a business. This means you must evaluate a business based on its economic characteristics, its competitors, and the quality of its management, rather than just looking at the ticker symbol. The second principle introduces the concept of Mr. Market, a mythical character who daily provides stock prices. Most people react emotionally to stock market fluctuations, but Mr. Market's mood swings provide an opportunity for investors to act when it's advantageous, without feeling compelled to follow the market's emotional roller coaster. The third principle emphasizes the importance of a margin of safety. Just as you wouldn't cross a bridge with a capacity of 10,000 pounds with a truck weighing 9,800 pounds, you should invest with a margin of safety, ensuring that your investments are fundamentally sound and protected against unforeseen risks. By following these 3 principles, you can build a robust investment strategy. However, all 3 principles are essential and work in tandem, much like the legs of a 3-legged stool. If you remove one leg, your investment philosophy becomes unstable. The most crucial aspect of successful investing over the long term is understanding the businesses you invest in. If you were given a substantial sum to invest, you need to evaluate various businesses within a limited time frame. The key factors you'd consider include enduring competitive advantages, a competent and honest management team, and a sensible price. Enduring competitive advantages, often described as a moat, are essential. You want to invest in businesses that have a unique position or strong brand that makes it difficult for competitors to encroach on their territory. This moat can be created through patents, location, or brand recognition. It's also vital to have confidence in the management team's ability and integrity. You wouldn't want to invest with a dishonest or incapable leader. Ideally, the business should be so good that even a somewhat incompetent manager can run it effectively. Lastly, you must assess the price. A sensible price is essential, because even the best business can be a lousy investment if you pay too much for it. You want to evaluate businesses without being influenced by the current stock prices to ensure a rational assessment. To find the right investments, you must be selective and eliminate companies that don't meet your criteria. Just as you'd screen out the worst businesses when choosing stocks from the Dow Jones Index, you should focus on finding the best opportunities. Remember that you don't need to trade frequently. You can take your time and invest when the conditions are right. In conclusion, these 3 simple investment rules offered by Warren Buffett serve as a valuable starting point for anyone looking to begin investing intelligently. The wisdom of the successful investor reminds us of the importance of understanding the fundamentals of investing, seeking opportunities with a margin of safety, and focusing on long-term investments. These principles can be a guiding light as you embark on your journey in the world of investments, helping you build a solid foundation for your future financial success. Remember to comment and subscribe to the VitalCash channel to stay updated on more valuable financial tips. Happy investing!